We're going to turn to this week's issue, though, and this week's online material in the form of our income majors. We will start with GSK, Julian. You covered the company from an income perspective for this write-up, looking particularly at its dividend prospects. I dare say we'll talk a bit about some of the wider issues as well. But to start with the payout, it's fair to say, following the divestment of Haleon a few years ago, GSK's dividend and yield isn't what it was, but it's still reasonable enough and could well tick up in the years to come as well.
Yes, I mean, it's pretty decent for the price. I mean, they pay out about 2.4 billion in dividends in 2024. If you compare that with the pre-Haleon split, that number was 3.9 billion in 2021. So it has come down substantially. The plus side is, of course, you're not paying a huge amount for that in terms of the shares. So forward PE ranges between 8 and 9 at the moment for 2026. And you're getting a dividend yield of well over 5%. So it's a pretty solid payout on its on own merits, really. And GSK, under the chief executive Emma Walmsley, has been radically reshaping it in order to support that. So they're trying to get more efficient. They're bringing in deals to restock the pipeline. I was looking at the pipeline the other day. They've got something like 20 in phase 3 or in registration with regulators, and that's the highest I can remember in years. I mean, the GSK went through a long period where it didn't seem to be particularly interested in drug research under the previous management, and that situation is completely reversed. So you can see that if those products are approved, a lot of them are in vaccines, the sort of traditional GSK specialities, but increasingly also in oncology areas where they were never particularly strong. You could see that the future revenues tied to that, those approvals will start to support a growing dividend, and the dividend seems to be forecasting a 6% growth over the next couple of years. So, investors, I don't think, can complain with that. But yes, it is a very cheap, by the standards of the sector these days, a very cheap dividend share.
Yes, there's that added attraction, isn't there, of, as you say, the valuation looks pretty attractive at the same time as you get paid to wait for that turnaround to keep going. There's also buybacks in the mix nowadays, which, as with a lot of FTSE 100 companies or UK companies of all stripes, are increasingly a factor. GSK has got a big buyback program going on, which, while not an ideal replacement for dividends, does add to the total return picture too.
It does, yes. I mean, they're buying back about 2 billion over the next 18 months or so. So that's quite a chunky lump of cash that investors will get if they want to sell a portion of their shares. But yes, it's not in itself a replacement for that guaranteed level of income, which is really historically always been the attraction of pharmaceutical shares, in that there has always been that stability of payout. But I mean, the company, it wants to be a growth company. I think that's the long and the short of it. They're trying, I think, in many ways to mimic the success of AstraZeneca. Since 2008, Astra consciously went away from being a kind of stodgy dividend share to being a growth oncology company. And investors who bought in at that point have made many times their investment. So there is a potential there to do that, and the company has a target of 40 billion of revenue within 5 years or so. I think the current level is about 28. So yes, that's at least a sign of their ambition. If at the moment that looks like a hill that still has to be climbed.
Mm. I mean, all these questions, just to go back to the mix of distributions and buybacks, they raise questions for income investors in terms of how they receive that income. And it's ironic in a way. Clearly, if you're a staid dividend share, as a lot of FTSE 100 companies get criticized for or did do a few years ago, you want to become a growth company. At the same time, a lot of investors still want that regular income and need it. And buybacks, while you can sell your shares, they're not as reliable, and you can't guarantee a regular payout as you can to an extent with dividends. So there's kind of competing objectives here sometimes between shareholders or a certain type of shareholder and the company itself. But anyway, I digress. Let's talk about that bid to reach the 40 billion revenue target in a bit more detail, because what is GSK pinning its hopes on? We've touched a bit on some of its strengths, but can we talk a little bit more about what it's doing to boost its sales?
Well, that's actually gets quite interesting. So it was one of the first companies in the last couple of years to go big on buying up Chinese biotech prospects. It's done a 500 million deal uh, with Henghui, I think you pronounce it, but basically they're going for they have this dual strategy of trying to get more efficient in how they do things. So that's tied up with using artificial intelligence and machine learning quite a lot in their drug discovery and kind of literature review functions. And apparently it has built up a reasonable reputation within the sector for actually having a very productive kind of AI program, which is kind of unusual. AI is a little bit hit and miss sometimes with drug discovery. It has this problem with hallucinations. Like I think we've all been there. We've used the chatbots that it sort of confidently gives you completely wrong information, and that can be quite serious if you're trying to find usable medicines. But yeah, so the AI side of it seems to be doing very well, and that has caught the eye of some investors. They're going big on getting more products through the pipeline in a slightly more timely way, and that is tied to getting more deals off the ground with promising biotech companies. And when I looked the other day, they had something like 20 phase 3 products in final stages of development or approval, and that's the highest level I've seen it for years. I mean, probably a decade or more that they've got that much in the tank, as it were, ready to get out and earning revenue. And so I mean, the chief executive has gone big on that, saying, well, we need this development pipeline to deliver, and they seem to be doing that by either insourcing expertise, by buying it, or trying to make their own processes much more efficient by investing a lot in AI as well. So it's a combination of those three factors, I think, that they'll use to try and get to this 40 billion target. And I mean, the analysts are generally positive that they'll make it. But it's still another 5 years before we'll see if that's the case.
We should touch on recent political developments, or developments which are tangentially related to politics, or in some ways in some countries. Just to wrap up, let's talk about, first of all, the regulatory risk in terms of the risks in the US about medicine pricing, also potential tariffs, and also the headlines we've seen in the UK this week about various pharmaceuticals cancelling their expansion plans. I mean, this all seems bound up in the fallout they've had over NHS pricing too. So there's been some suggestion they're acting in concert, in league, in a cartel type behavior, if you will. I think someone made those suggestions anonymously to one of the papers this week. But there's no doubt that there is some angst there between the sector and the government in the UK, at least in terms of plans. So can we talk a bit about some of these risks to the sector?
Yeah, certainly. So, I mean, the risk obviously falls on two sides. One is the regulatory risk of getting products through the system to approval. If you imagine that the average spend now is well over $1.5 billion, if it fails at phase 3, then that's $1.5 billion or whatever that goes down the Swanee. The other side is the reference pricing, we call it, which is the standard pricing that healthcare systems will pay for products. And yes, the kind of argy-bargy this week has been over the NHS's refusal to raise medicines prices in certain classes of medicines. A lot of them are quite expensive oncology medicines, but there's been arguments even over the provision of Mounjaro, for example. That's the weight loss drug, and what the service is prepared to pay for that. The reason why there is always this argument is that the NHS is the only monopoly healthcare service buyer in the world. if you compare that with the US market, which is essentially an open medicines market, companies there at the moment can charge more or less what they like, except there is now a risk there that the Trump administration will force companies to drop prices if they want to sell their drugs into the Medicare system, which is a big drug, one of the biggest drug buying entities in the world. And that the price they pay there often then becomes what other people are prepared to pay. So there is the risk of a downward spiral on drugs prices. But the NHS one is a strange one in a way, because companies don't make a huge amount of money out of the service, because almost all of except for very specific classes of new medicine, a lot of it is well-established generic products that we tend to use, which cost pennies on the dollar. And I think a lot of these maneuverings around saying, well, we're not going to expand in the UK is largely symbolic. And it may be tied to other reasons as well, that the tariff threat makes expansion here less attractive than it is to moving your capital to the US and building a whole new suite of facilities in various US states, which is exactly what GSK itself has announced with a kind of 30 billion investment, and AstraZeneca is investing 50 billion. And I think it's more about where they're shifting capital. I'm not sure that. I think this argument over prices is more cover for saying, well, actually, we need to put this somewhere safer, as it were. It's not going to be so exposed to headwinds.
Yes. I mean, I should say GSK was not one of the companies cancelling UK investment this week, but as you point out, it is one which has promised a big amount of investment in the US. Undoubtedly, in part, all these companies are doing this with one eye on pointing to this and then trying to ensure they don't get penalised in other ways in the US, which is the way things are going now for various reasons, which we will no doubt touch on in future episodes.